Hi, I'm Marc, and on this channel I talk about Brexit and UK politics. Inflation in Great Britain remained surprisingly high in September, as we heard now. In a year-on-year comparison, consumer prices rose by 6.7%, just as strong as in the previous month, as the ONS Statistics Office announced on Wednesday in London. On average, analysts had expected the inflation rate to fall to 6.6%. Month on month, the cost of living rose by 0.5%. However, there was a slight decline in core inflation. The strongly fluctuating prices for energy and food are taken into account there. In this regard, the Statistics Office reported a price increase of 6.1% for September after the annual rate in the previous month was 6.2%. Analysts had expected a larger decline in the core rate, though. Compared to other major economies in Europe, British inflation is comparatively high. The inflation rate in the Eurozone was only 4.3% in September. I'll talk about this a little bit more later. A strong price driver in Great Britain in September was the cost of food. The Statistics Office reported an increase of around 12% year on year. Prices in restaurants and hotels also rose at an above-average rate. The British pound responded to the price data with gains in trading against the US dollar. The higher-than-expected inflation increased speculation on the market that the British Central Bank would raise interest rates further in the fight against inflation. Rising interest rates usually support a country's currency, and that's why, despite this news, it went up. British Chancellor of the Exchequer, Finance Minister Jeremy Hunt, expects inflation to fall further this year. As we have seen in other G7 countries, inflation rarely falls in a straight line, but if we stick to our plan, it should fall further this year. That's what Hunt said in a statement, and he also said, "Today's news shows this is even more important so we can ease the pressure on families and businesses." Previously, as noted, the Office for National Statistics, the ONS, announced that the Consumer Price Index rose 6.7% year-on-year and 0.5% month-on-month in September. The experts from capital companies also expected inflation rates in Great Britain to continue to fall, but the decline in prices is likely to be much smaller. The recent rise in oil prices to $92 a barrel and the dramatic 35% jump in natural gas prices since the start of the Middle East conflict raise the risk that inflation will decline more slowly, perhaps to an average of 3%, they say. On balance, experts do not believe that the British Central Bank will lower interest rates before the end of next year. Prime Minister Rishi Sunak's government has set itself the goal of bringing inflation down by half by the end of the year, also with a view, of course, to next year's election. Many experts believe it is plausible that inflation could fall to around 5% by December. This would be half the level from January, but still bad. The central bank recently predicted that inflation would be above the target of 2% by the beginning of 2025 still. High inflation is weighing on consumption, and a recently published survey found that consumers are increasingly holding their money together, which is understandable. And as expected, inflation in the Eurozone weakened significantly in September in a comparison. The inflation rate fell from 5.2% in the previous month to 4.3% as the Eurostat Statistics Office announced on Wednesday in Luxembourg after a second estimate. In a month-on-month comparison, consumer prices rose by 0.3%. This means that the first survey was confirmed as analysts expected. Core inflation, which excludes volatile prices for energy and food, also declined. Here, the annual rate fell to 4.5% in September after being 5.3% the month before, and here too the first estimate was confirmed. The strongest price drivers were food and luxury foods. In contrast, energy prices continued to fall year on year. Despite the weak inflation, the European Central Bank's medium-term inflation target of 2% is still clearly being exceeded, of course. Last year, inflation was at times in the double digits as a result of the Ukraine war. The ECB has been combating high inflation by raising interest rates for more than a year now. I also have a small update on another pressing issue for you as well that has nothing to do with inflation. Kind of. British Business Secretary Kemi Badenoch said on Wednesday that she was very optimistic about finding a solution for automakers to avoid looming tariffs on the trade of electric vehicles with the European Union. I don't know where she takes that from. We are regularly raising this with EU counterparts, and it's just simply the nature of trade negotiations and trade policy, is what Badenoch said at the Society of Motor Manufacturers and Traders trade event, so the SMMT. These things tend to take quite a while and then get delivered at last minute. I'm personally very optimistic that we will find a solution. As I mentioned a lot of times already, under the so-called rules of origin agreed in the Brexit trade deal, EVs need to have 45% EU or UK content from 24, with a 50 to 60% requirement for their battery cells and packs, or face tariffs. But European and British EV supply chains are not yet advanced enough for electric cars produced to meet those rules, so automakers face a 10% tariff. The SMMT, the British auto industry trade body, has asked for a waiver on the rules to be extended for another 3 years, as did continental manufacturers. Without a renegotiating of the rules, car plants could close with the loss of thousands of jobs, as the world's number 3 automaker Stellantis has said. And an SMMT analysis showed on Wednesday that EU-made EVs could cost £3,400 more on average in Britain, potentially hindering the transition to greener vehicles. Badenoch also said, without providing further details of course, that the government could take other steps to support the auto industry if negotiations with the EU failed. I think that if the EU does not agree to what we think is the best solution, then the UK government is going to have to step in and do something different, she said. Well, whatever she means with that, because she doesn't tell us. But we all know generally that Brexit does have an impact on costs. Quantifying the exact cost of Brexit on the British economy, of course, is a complex task, as various factors contribute to price changes and economic fluctuations. However, several studies and analyses have attempted to estimate the impact of Brexit on costs in Britain. And today, again, I have some of those key findings for you. The Office for Budget Responsibility, the OBR, the UK's independent fiscal watchdog, estimated on October 21 that Brexit would cost 4% of GDP per annum over the long term. This translates to £32 billion cost per annum to the UK taxpayer. And a study by the Centre for European Reform found that by the end of 2021, the UK economy was 5.2% smaller than it would have been if the UK had remained in the EU. This equates to a loss of £31 billion in economic output. Another study by the LSE Centre for Economic Performance estimated that Brexit had reduced UK trade by 15 to 30%, leading to higher prices for imported goods and services. The Resolution Foundation, that's a think tank focused on living standards, found that Brexit had contributed to a rise in food prices, particularly for fresh fruit and vegetables. And these estimates suggest that Brexit has had a significant impact on costs in Britain, reducing economic output, increasing trade barriers, and contributing to higher prices for consumers. Of course, the exact magnitude of these effects is still being debated, but there is a consensus that Brexit has had a negative impact on the UK economy, except some hardcore Brexiteers. Please note that these estimates are based on complex economic models and assumptions, and there, of course, is a degree of uncertainty around the precise figures here. However, they provide a general indication of the scale of the economic impact of Brexit. But we, anyway, have not reached the end of it all. The introduction of full UK border checks on imported goods from the EU, scheduled for next year, is also expected to have a range of impacts on businesses, consumers, and the overall economy. One thing is increased costs and disruptions to supply chains. Businesses importing goods from the EU will face additional costs and administrative burdens due to the new customs declarations, safety and security declarations, and indeed physical checks at the border. These additional checks will lead to delays at ports and border crossings, potentially disrupting supply chains and causing shortages of certain goods. And businesses may need to adapt their supply chains to account for these delays and, of course, increase costs, potentially leading to higher prices for consumers. And consumers may face higher prices for imported goods from the EU due to the increased costs for businesses. There could be potential shortages of certain goods, particularly fresh food and agricultural products, due to supply chain disruptions. And consumers may experience delays in receiving their orders for important goods due to the longer processing time at the border. The introduction of full UK border checks will reduce the trade between the UK and the EU, potentially leading to a decline in economic output. And increased costs for businesses and potential supply chain disruptions can even lead to job losses in certain sectors. Higher prices for important goods will contribute to inflation and put pressure on household budgets. The overall impact of the introduction of full UK border checks on imported goods from the EU will depend on the effectiveness of mitigation measures and the ability of businesses and consumers to adapt to the new requirements and the competences of the border guards involved there as well. They are still lacking a lot of those. But if you want to know more, the next video is right here in the end screen. I'll see you there. I'll be back.